Hi, I'm Patu from freefincal. Today let's take a look at UTI Nifty Midcap 150 Quality 50 Index. The fund is currently in its NFO period. DSP has a ETF based on this index, and after about 3 months since inception, it has about 36 crores of AUM, which is not too much. Let's see how the UTI fund fares. So the quality index is part of the family of factor-based indices in which you have some kind of metric like volatility, momentum, alpha, return on equity, PE, PB, etc. used to choose stocks from a market capitalization based index. So you basically combine active stock selection and passive investing in this way, and there are several types of strategies, and quality is one such. So you have the Nifty 100, the top 100 in terms of market capitalization, forming the large cap family, and then the next 150 stocks is called the mid cap universe, and the quality index will take 50 stocks from the mid cap index. Now quality, the definition is kind of arbitrary, and it basically takes three factors. It takes into account debt to equity, then it takes into account last 5 years earnings per share growth variability, and one more, I forget one more. So it's return on equity. So it gives three factors, equal weights: ROE, debt to equity, and EPS growth variability. So for the financial companies, financial sector stocks, it removes the debt by equity in the equation. So, but it must be understood that the way we define quality is arbitrary. I mean, unlike volatility is a well-known standard universal definition based on the standard deviation. Whereas, how do you define a quality stock? There are many ways to do it. I mean, there are so many balance sheet terms which you can use. So you must understand that this definition is arbitrary. And I had pointed out when the index was launched that, in fact, I have pointed it out twice, that actively managed mid-cap mutual fund would struggle to beat the factor-based mid-cap index. Of course, it is also true that the active mid-cap funds are also having trouble beating the mid-cap, the plain mid-cap 150 index also. That's another matter. But I had shown that the quality 50 index is hard to beat earlier. Now, so this means that there are several questions which we should ask. Can we use the quality index, quality 50 index instead of active mid-cap funds? Can we use the quality 50 index instead of mid-cap 150 or instead of Nifty Next 50? And one other question is, instead of buying these index funds, can I build a DIY quality mid-cap portfolio on my own? So one thing I must point out is that since interacting with a friend who I cannot name, and since he published his article called Data Mining in Index Construction, my fascination with factor-based investing has considerably reduced. I mean, I have understood how these index curators they choose metrics that have done well in the past. It's designed to show past outperformance, but they may or may not sustain in future. I had also written an article on should I exit Nifty Next 50 because of Paytm, Zomato, and Nykaa inclusion, to point out that index funds have got this kind of curator risk. Just like there is a fund manager risk in active funds, there is a curator risk in index funds where they can change the inclusion criteria at will. Now, if you go by what UTI has done for the momentum index and the low volatility index, I think you can expect a total expense ratio of about 0.4% to 0.5% for the direct plan, of course, but that can be higher. I don't know, because it's a mid-cap universe, they can expect to get more income from it. I don't know, but that's my expectation. Now, so let's take a look at the performance, but we must understand that the index was launched only in October 2019. The history that is available from April 2005 is back tested, and it does not reflect index movement with real-time trading, constituent changes, etc. Constituent changes will be there, but when you do in terms of real time trading, when you are going to announce that some mid-cap stock is going to be included in a quality index, then there can be price changes accordingly for that mid-cap stock, and similarly if you say that it's going to be removed and so on. So that kind of information cannot be back tested, and that's important to understand. So let's now take a look at this performance. I might have to pull this out into new tabs. Let me do that. So this is the first graph. We are seeing the 5-year rolling returns. The red line is Nifty Next 50. The pink line is the Quality 50 index. The brown line is the Midcap 150. And you can see over 5 years you can't really tell much, but there have been some regions where the Quality 50 has done well and some regions when it has not. So you cannot expect outperformance over 5 years. That much must be understood. Now over 10 years things are a little different, but you must understand that it's only in the last 6 years data is available. 10-year returns are only available for the last 6 years. That is in the rolling return chart. So a lot of things can change, and you can see the pink line, the Quality 50 has outperformed consistently both the Nifty Next 50 and the Nifty Midcap over 10-year period. One thing that you can see here is that there's a slightly lower spread in returns. The maximum return and minimum returns, there's a small reduction in the spread for the Quality 50, but it's not very obvious. We'll probably look at it in another graph, but you must understand what happened here. You can see the dramatic fall. You can see it in February 2018, or not in February 2018, I should say in early 2019, somewhere here, there was a dramatic fall in the Quality 50 return. So that much also we must expect when we invest. Of course, these are long-term returns. And this is probably a little more interesting. This is the standard deviation over 5 years. You can see the Quality 50, that is the pink line, is alongside the two low volatility indices, the Nifty 100 low volatility 30 index and the Nifty 300 low volatility 50 index. So you can see that the volatility of the Quality 50 is comparable to that of low volatility indices and significantly lower than Nifty Next 50, the blue line, Nifty 200 momentum 30 index, the yellow line, and the brown line, which is the Nifty Midcap 150. So there's significantly lower volatility, again of course based on back tested data. We must keep that in mind. And here we have the 5-year comparison of the Quality 50, which is the pink line. The green line is the Nifty 100 low volatility 30, the white line is the Nifty 300 low volatility 50, and the yellow line is the Nifty 200 momentum 30. So you can see the momentum swing is significantly much more. I should probably not have talked about the ups and down movement in the return graph. That's probably incorrect. This is more appropriate to talk about it here. You can see that the momentum is a lot more volatile and it has underperformed significantly over several 5-year periods. Whereas of course the low volatility has got much more stable returns. The minimum and maximum return swings are much lower in the low volatility indices. The Midcap Quality 50 has got a higher return spread, but not as much as the momentum, and it has also outperformed the low volatility indices for some regions in time. Not always, but not everything will work always. You can see here there are regions where the momentum did badly, there are regions where the momentum did well, there are regions where quality did well, and low volatility is more or less reasonably consistent, but it is not outshone, but it is also not tremendously underperformed except for one region here. Of course, again here, of course here and here. It's a lot more stable choice, but I should say, that's a better way of putting it. The Quality 50 and momentum are not as stable as the low volatility, but momentum is a lot more unstable or a lot more volatile, I should say, than the Quality 50 index. and this is over 10 years, this probably is a better demonstration of how nothing will work all the time. You can see here quality did better here, but momentum outshone it in the last couple of years, yes, or so, whereas the low volatility has more or less, has stayed about just about where it is. In terms of return spread, the lowest is for the low volatility, but that's it. I mean, you can't, when you invest, you don't know what the future is going to be, and you have to appreciate that. So let's now try to answer these questions. Of course, these are my opinions, and your opinion, your interpretation based on this data can be very different. Is the quality 50 index fund a better choice than the UTI low volatility index fund? I would, of course, there's not enough data to say that. We must appreciate, although you see that the quality 50 has outperformed the low volatility for some regions, in the past, it's an apple versus orange comparison, because whether you choose 50 stocks from Nifty 300 or whether you choose 30 stocks from Nifty 100, the returns are more or less the same. So which means that the low volatility indices are large cap oriented indices, whereas this is a mid cap index. So you can't say you can't ask, can I replace a large cap index with a mid cap index or vice versa. That kind of an argument doesn't make sense. So in that sense, it's a bit of an apple versus orange comparison. If you ask, can I hold both low volatility and quality 50? If you want to take the chance, appreciating the limitations of factor indices, yes, you can. I'd like to make it very clear, I have no skin in the game. I will not be investing in the quality 50 index. I have invested in the low volatility index, but for my circumstances, there's no need for a quality 50 index. I have already pointed it out that between quality and low volatility, if I had to choose, I would choose low volatility, because the definition of low volatility is more universal, it's well established. The definition of quality is not. So because of that reason, I will prefer not to choose quality 50 index. Is quality 50 better than momentum 30? Again, it's an apple versus orange comparison, because quality 50 is a mid cap index, whereas momentum 30 is a large and mid cap kind of index. But if I look at the kind of risk that momentum has, then I would and if you ask me which will you choose between these two, and only between these two, then I would choose quality 50 instead of momentum. Can I use midcap 150? Can I use quality 50 instead of active midcap funds? We have already shown that these funds struggle to beat quality 50 consistently. If you consider the period between February 1st to February 3rd, 2020, that is a month before the crash, only 8 out of 21 actively managed mid-cap funds were able to beat the quality index. For the next 2-year period, from 23rd March 2020 to 23rd March 2022, 18 out of 24 actively managed mid-cap funds were able to beat quality 30. However, there's a very important point. However, if you look at the winners in the first 2-year period and the second 2-year periods, they completely changed. In the first 2-year period, Axis Midcap, which was the darling of investors, DSP and Taurus, they were all winners, but they ended up on the losing side in the second 2-year period. Also, midcap funds from Motilal Oswal, Invesco and Tata were comfortable winners in the first 2-year period. They were able to comfortably beat the quality index, but they just about managed to beat the quality index in the second 2-year period. So there's no guarantee of consistent performance from an actively managed mid-cap fund. So if you, again, understanding risks, if you are ready to take a chance with a factor-based index, I would say you can choose the quality 50 index instead of a actively managed mid-cap fund. There will be a little bit lesser cost, but again, you have to understand it, the limitations, what you're getting into. Can I use the quality index instead of midcap 150 or Nifty Next 50? Now, again, there is a risk of the factor, but I mean, Nifty Next 50 is a frustrating index to hold. So And also, if you look at the expense difference between Nifty Next 50 and the expected expense of this fund, there will not be much difference in my opinion. So what is the worst that can happen by holding Quality 50 instead of Nifty Next 50? I don't think it's going to make a big difference. If you are willing to take the chance, yes, you can replace Quality 50 by Nifty Next 50. Of course, there's no data to support this. This is just my opinion. It's up to you to take a call. Remember, I am not investing in either Midcap 150 or Quality 50 or Nifty Next 50. Again, the same idea between, argument between Midcap 150 and Quality 50. I mean, we have already shown that the tracking errors are going to are high in the Midcap 150 universe. Tracking errors may be a little bit less in the Quality 50 index, but even if the tracking errors are that bad, there's a potential chance of outperformance because of the quality factor. If you are willing to take that risk, yes, you can. Again, there's not much of a difference in the expense ratio. I think maybe a little bit higher, but not much. So again, it's a possible substitute. Yes, we don't have but that's again, we don't have any data to prove that, but it's an opinion. Instead of buying this index fund, can I build my own DIY portfolio of Quality? This again, it cannot be back tested. Experienced investors can try it. New investors should not try this gymnastics. Finally, all that said and done, this is a new fund. So you can wait a few months, look at the tracking error and then decide, and there's no hurry for you to rush in now and invest.